In this video, we're going to look at some examples for Chapter 2 in Business Finance, some of the calculations that are covered in Chapter 2. In this first example, we're going to look at the creation of a balance sheet with some various information about a company. So we have information about a company and we have a balance sheet template here. So we just need to fill in our template. We have current assets of $2,090 and we have fixed assets of $9,830. If we add those two items together, that gives us our total asset amount for our balance sheet. The other two numbers that were given are current liabilities of $1,710 and long-term debt of $4,520. What we are missing is our owner's equity. However, we know that owner's equity must, or total liabilities and equity must equal total assets. That's the balance sheet equation. The general accounting equation is that assets equal total liabilities plus equity. So our owner's equity amount is whatever number we need to get this number to equal 11,920. So if we take 11,920 minus our total liabilities, we get an owner's equity of $5,690. So that is the total owner's equity for this balance sheet. That is what we get to make our balance sheet equal. The last thing that we're asked for in this calculation is our net working capital. So we know net working capital is current assets minus current liabilities. So we have current assets, 2,090, minus current liabilities of 1,710 for a total net working capital of $380. The next example, we're going to look at an income statement for an organization. So we have information here that we need for our income statement. So first, our sales of 634,000, and then our expenses or cost of sales of 328,000, and our depreciation expense of 73,000. Sales minus costs minus depreciation expense equals earnings before interest and taxes. We then have our interest expense of 38,000. So our earnings before interest and taxes minus our interest expense gives us our earnings before taxes. The next thing we need to calculate for our income statement is the amount of tax that we owe. This problem tells us that we have a tax rate of 21%. Therefore, the amount of tax we owe is 21% of our earnings before taxes. So we take our earnings before taxes times 21%. So our tax amount is $40,950. That gives us a net income of $154,050. We then have these additional three equations down here. The first one asks us how much is added to retained earnings. We know from taking accounting classes that the retained earnings equation is beginning retained earnings plus net income minus dividends equals ending retained earnings. So from this information, our addition to retained earnings is net income minus any dividend payments. So we can look at our information and see if we have any dividend payments. And we do. We have $68,000 in dividend payments. So we would take net income minus $68,000 in dividend payments. This equation is earnings per share. Earnings per share, or EPS, is calculated by taking net income divided by the number of shares outstanding. This problem tells us that we have 35,000 shares of common stock outstanding. So our net income divided by 35,000 shares of stock outstanding for an earnings per share EPS of $4.40. Our dividends per share is the total dividends divided by the number of shares outstanding. So we take our dividends of $68,000 divided by our shares outstanding of $35,000, giving us a dividend per share of $1.94. Any person that owns a share of stock with our company gets $1.94 times the number of shares that they own. In this example, we're going to look at taxable income and how much a person pays in income tax based on the current table for income tax rates. Different levels of income are taxed at different rates. The current tax law passed in 2017 is included in this table for individuals. So on the first $9,525 of income, we pay 10% in tax. Then on the next threshold of income between $9,525 and $38,700, you pay 12% of tax, and so forth. So we have a person who has $189,000 in taxable income, and we want to find out what the total tax amount that they pay is. So we start with, I'm going to put a sum here to add up this column because we want to make sure when we're going through our taxable income that we don't pass 189,000. I'm also going to add up our total tax amount that we're going to be calculating. So we're going to start in the 10,000 or in the 10% bracket. So we pay 10% of the first $9,525 of income. We take that 10% times $9,525. Next, up to $38,700, we pay 12%, but we don't pay on any income we've already been previously taxed on. So our top of our threshold is $38,700, and we're going to subtract the income we've already been taxed on. That leaves us with $29,175, and we pay 12% on that portion of our income. Our next threshold is from $38,700 to $82,500. So we're going to take $82,500 minus the total that we've already paid in previous years, leaving us $43,800 we're going to pay 22% tax on. 22% times $43,800. And we continue working through that until we hit $189,000 in income. The next bracket is $82,500 to $157,500. So we're going to take that top part, $157,500, minus the total of the previous three bracket amounts, gives us $75,000. We're going to take 24,000 times 70 or 24% times 75,000, we get 18,000. Now the next bracket goes up to 200,000, but we only have taxable income of 189,000. So we're going to use 189,000 as our top amount, minus all of the tax that we've already paid, leaves us a total of $31,500 to be taxed at a rate of 32%. So the total tax amount that we pay on $189,000 in taxable income is $42,169.50. The average tax rate is calculated by taking the tax amount divided by the total taxable income. So if we divide 42,170 by 189,000, we get an average tax rate of 22.31%. Our marginal tax rate, if you remember from the textbook, is whatever we pay on one additional dollar of income. So if we had taxable income of $189,001, what would our tax rate be? Well, it would be 32%. In fact, we would pay 32% on the next $11,000 worth of income because that is what it would take for us to get to 200,000 before we are bumped up to the next bracket. So our marginal tax rate is 32%. In this problem, we're going to be looking at creating the financial cash flows from Chapter 2. Remember that the financial cash flows that are discussed in Chapter 2 do not match accounting statement of cash flows calculations. They're slightly different, just so you don't get confused about why it doesn't look like a statement of cash flows. We start with an income statement. We have sales of $38,530, costs of $12,750, depreciation expense $2,550. Our earnings before interest and taxes is sales minus costs and depreciation expense. Our interest expense is $1,850. We subtract that from EBIT to get our earnings before taxes, and our tax rate is 1%. So we take our earnings before taxes times 21%. This leaves us with a net income of $16,890.20. Operating cash flow is earnings before interest and taxes plus depreciation minus taxes. So we have to add depreciation back in because depreciation is a non-tax expense. And then we remove taxes because taxes are are paid in cash. This gives us our operating cash flow. Finance treats interest as a finance expense and not as an interest expense. That's one of the reasons that we don't start with net income when we're doing the calculations here like you would on an accounting statement. So for operating cash flow, we have $21,290.20. This looks for our net capital spending. This is also a part of our cash flow identity for a company. So when we're doing our net capital spending amount, we are looking at ending net fixed assets minus beginning net fixed assets plus depreciation expense. So ending net fixed assets minus beginning net fixed assets plus depreciation expense. So the net capital spending is $527,000. The last part of cash flows from assets is change in net working capital. So we have information about 2018 current assets, 1,490, and current liabilities of $1,210. In 2019, we have current assets of 1,675. Gave a zero too many. And current liabilities of 1,290. When we're looking for the change in net working capital, we're looking at the difference in net working capital from 2019 to 2019. Net working capital is current liabilities minus current assets. So if we're putting that into Excel, we need to use parentheses. So we make sure we keep 2019's net working capital together and 2018's net working capital together. So we're going to start with current assets minus current liabilities in 2019. And then we're going to subtract the net working capital from 2018, which is 2018 current liabilities or current assets minus current liabilities. We get a change in net working capital of $105. Our next example that we're going to look at is the cash flow to creditors. Cash flow to creditors is interest paid minus net new borrowing. Net new borrowing is the change in long-term debt. So we're going to put our long-term debt in 2008 is $1,350,000. One too many zeros there. And in 2019, $1,470,000, and our interest expense is $97,500. So cash flows to creditors is interest paid minus the change in long-term debt. So interest minus the change in long-term debt, which is 2019 long-term debt minus 2018 long-term debt. So cash flows to creditors is negative $22,500. This last example looks at the last cash flow identity calculation, which is cash flow to stockholders. Cash flow to stockholders is dividend paid minus our change in equity. So we're going to look at our common stock amount is $120,000 in 2018, and our additional paid in is $2,289,000. In 2019, our common stock is $137,000, and additional paid in is $2,568,000. We have cash dividends of $159,500. So now what we're looking for is the change in capital or in equity. So we need the total equity for that amount. So we have cash dividends minus the change in equity. So we need 2019 equity. So we add those two together minus 2018 equity. And we get negative $136,500.